Barry James Dyke is not your typical guest. He's a researcher, an author, and frankly, one of the only people I know who's willing to take shots at powerful institutions and then back it up with actual receipts. And what he's uncovering right now should make anyone using life insurance or planning for retirement to pay attention, because private equity is moving into the insurance world. And when that happens, incentives change. And we've already seen real companies fall apart and get hollowed out, names like Phoenix Life and even Ohio National, which used to be one of the good ones before it lost strategic oxygen, got sold and rebranded. If Wall Street and private equity are coming for life insurance companies, what do you need to know to protect your family in your retirement? And why, in a world where things are getting riskier, more complicated, properly structured whole life insurance with the right kind of company can still be one of the best foundational assets you can own. Barry, welcome back to the BetterWealth Show.
Great to see you, Caleb. You're the future, man.
Well, you say I'm the future. You are a researcher. You're working on another book. I won't tease the title, but you're going to be, let's just put it this way. You're going to be taking a lot of shots at some very powerful people, powerful institutions. And a common theme is around this idea of private equity. And I've got big questions about, are private equity coming for the insurance companies? Are private equity, how is it going to affect our wealth? Understanding what you've done researching private equity and Wall Street and BlackRock. But before we jump into that, I think it's important to define what is private equity and how does it work?
Well, private equity, and actually the concept of private equity, it's been used to be called bootstrap financing or merchant banking or whatever. It's the idea of buying a company and actually using the assets of the company itself to buy the company. And this was in the 1980s, they call them the corporate raiders or the leverage buyouts, okay? And this was when we had guys like Carl Icahn taking over TWA, which he was actually doing is buying the airline with their own assets, believe it or not, and using very little of their own money. There's a space for it in any economy, but like most things on Wall Street, it's overdone, and now it's metastasized into a pandemic of corruption. And I'm not making this up. I'm not the only person to think about this. I've actually had some great mentors. Eileen Applebaum, Center for Economic Policy Research, and Ladola Alafu, he's a professor of economics. So I've had some really good mentors. And then there's other great writers like Gretchen Morgensen's wrote about it. And so the idea is essentially you take a company, let's say a company worth $1 billion, let's say, all right? Now, it's not the private equity firm actually buys the company. This is the whole thing. It takes you a while to figure this out, but it's very simple. So the private equity is just the manager, all right? So they raise a fund and they go to, say, primarily pension funds, like you're in Tennessee or I'm in Florida right now, or it could be anywhere in Colorado, whatever. And they go to these public pension funds to get the money. CalPERS being the biggest two. And they take a company, say for $1 billion, which is maybe 80% equity and 20% debt. And they go to the pension fund and they raise money, let's say $200 million. And they may put in, say, 1% of their own money to buy the company. So are you with me this far? So they take a company who's 80% equity and 20% debt, and they flip the whole model. So now it's 20% equity and 80% debt.
They're being very creative on how to strip all the money out of a company, and some will take off and a lot will just crumble. Private equity plays off of how many ones need to be home runs. Like they're really thinking like if 1 out of 10 hit is great, then we're good to go.
It used to be a lot better when companies were cheaper, but now they're in a real problem now because they can't sell the company. In private equity, there's only 2 ways to get out of these deals for the company itself: is to sell it to a greater entity or bring it public. Now, let's get back to this company. So we buy this company for $1 billion, let's say, and so we get $200 million of other people's money. It's always about other people's money. And they go to the banks, they go to JP Morgan or Goldman Sachs or Morgan Stanley, who are really big players in this, or Credit Suisse, but Credit Suisse no longer exists. And they go in and say, hey, look, we have this company we want to buy. And the banks get all excited about it because it's a very high margin debt for them. So banks will, as a consortium or syndicate, will put together, say, $800 million of debt. And then they'll take this debt, and then they'll sell it to another entity, whether it be a mutual fund like Vanguard or Fidelity or whoever, okay? And then the general partner, who is the private equity firm, maybe they'll put 1% of their money into this deal. But when they put the deal together, Caleb, they get generally about 1.5 to put the deal together. So the money good right out of the gate. Now on top of this, they get a 2% management fee for the whole deal. So when you get $1 billion deal, whatever, you get a 2% fee, you can make a lot of money. just by raising $1 billion. Because the money with private equity, Caleb, is locked up. It's contractual. It's a private contract, hence the word private equity. So it's locked up really for a period of 10 to 12 years. Generally, sometimes I've seen some of them as long as 15 years. So if you just raise a lot of money in private equity, you're going to make a ton of money for doing nothing. Now, the thing is that they're going to be making a lot of money just in the fees, and the whole thing is, which Ludovic Falvey out of Oxford shows, they actually make more money in fees than they do in the carried interest. So, but let's say they're successful. So let's say they buy this company for $1 billion, and they're managing. They get a 2% management fee. They're getting other fees. They can get monitoring fees and other things like that. They're also, everything's done, by the way, everything's done in secrecy. There's no transparency. And when people do things in secrecy, they have usually something to hide. And these
Yeah.
guys hide a lot. And it's, and Jeffrey Epstein was in with all these guys. But anyways, so let's say they buy a company for $1 million. Now, the whole thing is, the whole model, Caleb, is subsidized by the taxpayer. Because all interest for paying debt is deductible. So they have $800 million worth of debt. That's a ton of interest, maybe $80-90 million here in interest. So the taxpayers are kind of taking up the pipe because they're paying for all this deduct this. Now you and I can deduct it, but not at this kind of scale.
So you're saying there's a lot of tax benefits to private equity that even if companies go under, people are able to get massive tax benefits because of it.
Yeah. So let's say they sell this company for like $2 billion. Let's say it's a home run, which it could be. There hasn't been that many lately, but they could be. They're going to get a 20% cut. The private equity firm gets a 20% cut of that $200 million profit. So the $800 million would go to the limited partners, the people who put up the money, and they would get the profit sharing. It's called carried interest, this is what everyone's talking about.
Mm-hmm.
But so not only you get the management fee and all the monitoring fees and the whole thing, that $200 million is taxed at capital gains rates. They're gambling with other people's money, and even if they make money, they're getting paid at capital gains rates. Now, conversely, but if the company goes bankrupt, it's the funds who went bankrupt. It's not the private equity themselves.
Private equity has touched almost every industry, I would imagine. In a private company, it's like, all right, they rolled up this company, it didn't work out. It is what it is. It's like that's a bummer, but it doesn't necessarily affect. You're saying it does still affect the taxpayers because we're subsidizing some of this stuff. But where does it get really bad when private equity is getting into the retirement planning space or the insurance space? I want you to talk to that, because if they screw that up, not only are they affecting the company, but they're potentially indirectly or directly affecting all the other people that are connected to those insurance companies and financial pensions and all. So I want you to dive into that, because you're one of the only people talking about this. My producer just told me something wild. Only 6% of you who have subscribed to our channel have enabled notifications for our videos. That means 94% of you watching right now won't get told by YouTube when we upload a new video. So whether you're brand new or one of our longtime subscribers, if any of our 1,000+ videos have helped you think differently or brought you value in any way, I'd love for you to hit that bell and turn on all notifications. We've got some incredible guests and conversations planned for 2026, and I don't want you to miss them. Thank you so much for supporting this channel, and I'm excited to keep growing with you.
That's actually the next book. I'm actually finishing that up. So this is a major problem. This goes back to before you were even born, Caleb, the collapse of Drexel Burnham Lambert and First Executive Life in 1989, and that was first major collapse of a life company, and that ended up in private equity hands. But so one thing about life insurance companies, because you're particularly life and annuity companies, they're promising benefits, retirement benefits, death benefits for a very long period of time. So they have to be ultra conservative in what they invest in, and which is prudent, okay. And there's the statutory requirements, which is really important to protect people, because we're talking about serious things here. Because where people save money for retirement is extremely important, okay? And no one in Washington is talking about this, okay? But there are some people, and such as myself. So you want to talk about the collapse about the old Phoenix Home Life.
Yeah. So and for those people that aren't familiar, can you explain what Phoenix Life was, what went wrong? Because I think that in itself is really interesting to be majority of insurance companies aren't anywhere close to collapsing, and yet this insurance company is going through some hard times would love to hear your reason why. But if you could just define what the issue was and the story, that would also help our listeners.
Oh yeah, so Phoenix Home Life and went to receivership, and that's
What does receivership mean?
well, a life insurance company can't technically go bankrupt like a normal corporation. They have to be taken over by regulators, okay, and a life guarantee. And
The Arizona insurance regulators has taken over Phoenix Home Life.
yeah, it was actually Connecticut. Oh, so the problem is that when Wall Street is involved in this, is that Golden Gate Capital bought Phoenix Home Life, I think in 2016. I can't remember the exact name, whatever, but I have anyone who wants to talk to me. I have the exact dates. And they bought the company, and they essentially bought a leverage buyout, and they had a variable life component. They essentially did what it's called the Texas two step. So they took the healthier company, and then they kept that alive, and then they took the variable life, which is it needs a lot of reserves and things like that, and they hived it off in another one. And they put it, and then they used a lot of crappy offshore reinsurance, and they used a XOS loss using captive insurance in Vermont. So essentially, there was no reserves, and they took it all out. But now essentially it's in receivership, and it's probably going to go into liquidation. And you have people 80, 90 years old that has some 10, 15, $20 million policies with Phoenix Variable Life, and now they're going to be 300,000 with the State Guarantee Association. And I know one of the attorneys is involved in that. So this is just an absolute nightmare. Okay. Now there's also been other examples of collapses like this, and this is private equity. This is Golden Gate Capital, and people don't believe me.
So private equity was one of the reasons why Phoenix Home Life just took a dump.
Yeah, there's no risk management. It's all about the money, and this is the problem with a lot of mutual funds today. But that was just one example of Phoenix Home Life. Now there's been other ones as well. If you look at Europe, there was a major insurance company that collapsed called Eurovita, Eurovita. Eurovita. It was an Italian, but it's huge. It was first owned by J.C. Flowers, and then he sold it to Sibin, which is a British private equity firm. They went into receivership. It's a mess. Another one is Global Bankers, which was the Bankers Life. I don't know if you ever heard of Bankers Life, but this is a big entity, and this is a guy named Greg Lindbergh out of North Carolina. And he kind of played copycat. And what's one of the things that you find with private equity? They're not very creative. They play copycat. They all copy one another.
But
When they
did private equity benefit from destroying a life insurance company? Who benefited from that? Because it feels chaotic as you're explaining this. Do they come in with good intentions and then it just falls apart and then they
well, all
leave?
right, so they go in there because say, hey, there's a lot of money in there. So a typical life company is not unusual for a life company to have 10, 20, 5, 10 billion in reserves. And they private equity says, hey, we can do better than this, and we can put in create our own private credit funds, and we can make more money.
But aren't there regulations? Aren't there regulations that stop insure? Like, how would, in your own words, tell me how Phoenix Home Life, what was the story of them collapsing? And I know you said you know people that are going to literally walk away with a lot less money. Like when
Yeah.
someone hears that, they might get scared of all insurance companies. So I think it's
Look,
important for us to talk about.
at the end of the day, you have to really pretty much use mutual fraternal companies. I don't want to scare people, but when you look at what's out there for people, I think using a mutual fraternal company with a good surplus and liability ratio is really the best ones to have. No, when you look at it, actually insurance companies, they're the best providers of retirement income of anyone.
So your newest book is on private equity. You wrote a book in the past and you mentioned private equity. So you're not shy about this. How does that affect us today who are trying to make the best decisions for our families, for our small businesses, for our wealth? Like knowing what you know, Barry, help us determine how do you think about money in the light of doing all this research, this dark research, quite frankly. It's like we got to pray for you to stay in a good headspace because you're probably just reading horror story after horror story and how private equity got into different sectors and it destroyed them. And so in your research, what have been some of the biggest eye-opening moments when you're researching how private equity is getting involved in these companies?
I guess this the financial sorcery, if you will. Things like, you ever heard of what's called a dividend recap? This is important for people to understand. So let's say we have a private equity firm, and let's say they bought this $1 billion company, and they're doing pretty well. So what they'll do sometimes is that the private company will do what is called the dividend recap, which means they bought this company for $1 billion. and they get it to grow it. Sometimes because they can't sell the company to a third party or bring it public, they'll do what is called a dividend recap. So essentially, they remortgage the company, okay, and they'll put more debt. Now, so they'll take this company they bought for $1 billion and they'll put another, say, $400 million of debt on the balance sheet. Now, the whole thing is the private equity firm, by the way, is not paying any of this debt. Okay, like you own a home, I own one, we're paying the debt. It's not the private equity firm paying this debt. It's the company they buy. Okay. So they put another $400 million of debt onto the successful company, which they have. They pull out a dividend. They take this dividend out of the company as what is called as a dividend. So technically it's tax. It's tax at capital gains rates. Again, the 20% goes to the private equity firm. The 80% goes to the limited partners generally. So they're pulling out a $200 million dividend funded with debt. And when I started understanding that, I said, "You got to be kidding me!" No, it's huge.
And it's happening in every sector.
It's happening everywhere, and we're subsidizing it. So I'll
All right,
give you a
so
great.
what are go on, Barry, you go.
So I'll give you a great example, and this pissed me off when I saw this one. There's a company called Johnson Controls, and they sold the battery division, like car battery division, and now it's actually a Canadian private equity firm. Now the Canadians, the Canucks are in this too. Okay, so it's not like we're not the only it's people involved in this. So the Canadian Brookfield bought this company called Clarios. It was Johnson Controls, and now it's the largest battery manufacturer for cars in the country, in the world. I think they employed something like 16,000 people. So anyway,
Wow.
all right, it's huge, in the Midwest somewhere, and so they bought it, and they did it. Now, because of Biden's, what you have to understand too is that private equity and venture capital and all these guys, they all survive off the government, and so because it was part of the Inflation Reduction Act from Biden administration, can't believe this, and they get like $1 billion. A Canadian firm owns the American largest electric battery factory in America. They get $1 billion tax benefit in 2024 from the government, from the U.S. So we're subsidizing Canadian private equity firm in our country, and they did a dividend recap, and I can give you the exact numbers. And they did a dividend recap for I think $4 or $5 billion.
It's crazy.
Okay, and that's what and people ask me why I get pissed off, and no
Do
one
you,
really knows about it.
a
And
Canadian
the whole thing is I
company,
have to testify in court.
didn't a Canadian company take over Ohio National and now it's called Augustar? Like,
Yes, that's very good. That's a very good thing. And there's a lot of
what happened? What happened to Ohio National? Like, did you do research on what happened there?
it's gross. It saddens me, when you understand it, because these guys are very clever, and I think what's the name of it? There's a new name for it. I mean, I don't have the
Is it
manuscript now.
Augustar?
There
Augustar?
you go. Okay.
Yeah.
Thank you. Now, actually, that used to be a pretty good company. I was actually the general agent with them for 20 years ago.
No,
Um,
Ohio National back in the day was an awesome company. What went wrong? Like, was there something with their annuity book of business?
yeah. They got way over the skis with variable annuities.
And then did they have to do this, or is it just a money grab? Like, I think the common theme is, it's one thing. I don't want people to just leave this podcast saying, "Oh, private equity is bad." I want them to know, what do we need to avoid to make sure that we're not doing business with companies that could be taken over by some of these stories. So how do we make sure that we don't have the next Ohio National that we have our clients in? And how do we make sure that we don't invest in companies that our money is going to take a dive because it's so that's selfishly, that's what I want to know. So what happened? And I still want more clarity on what happened to Ohio National and what happened to Phoenix Home Life, because as I chat GPT, it seems like Phoenix Home Life had issues 20 years ago. So this is not a new thing.
Variable life it's been a problem, but it's been a problem for Metropolitan Life, and it's been a problem for and this is why but so for example, Metropolitan had a real big problem. They were one of the biggest insurers in the world, and they because there's such a problem with the variable life, which I'm not I know I've never been a believer of variable life. Years ago, 20, 30 years ago, it was a pretty good product, but now all the risk is really shifted onto the consumer. So I hate that. And so the variable life is a big problem for Phoenix Home Life. And it wasn't just it's not private equity, but they thought these guys with their Harvard MBAs could take over this company, but they're very smart too, and they know what they're doing, and they know that it's the State Guarantee Association. And private equity is not just big in the life business; it's in everywhere now. I mean, you look on the Super Bowl as it last night. I was looking at, because I'm so jaded at this point. I'm looking at the Dunkin' ads, and I'm saying, how many people really know who owns Dunkin's?
Is it private
Yeah,
equity?
well, what? It's private equity. It's Roar
Yeah.
Capital, I think, out of Atlanta. Okay, so I mean, it's just everywhere. I mean,
Yeah, it's everywhere. Now, we are independent, so we work with lots of different insurance companies,
yeah.
and I never wanna go through what Ohio National went through and that whole deal. How do we make sure that we're doing companies like, how do you pick the right company? Because Ohio National was mutual. They did have pretty good ratings. Now there was a their ratings are starting to take a little bit of a dip, and maybe that was a warning sign. But what is like, when you look at some of the major mutuals, like you have New York Life, Mass Mutual, Northwestern Mutual, Guardian, you have Lafayette Life, which I know we both have
Yeah,
relationships with. You have Penn Mutual, you have One America, you have Emeritus. Like, are any of the companies that I just mentioned, like John
those are all
Hancock,
good
are
companies. I mean, you follow me? And because they actually have real surplus and real liabilities, and they're not using Bermuda. It's a much bigger, more complex, problem you get in a small podcast. But I think really that, you have to have people who advisors who I think have love and caring for the people. And unfortunately, there's a lot of advisors out there, Caleb, who they just look at what they're going to get paid in commission, and everyone survives off commissions. I mean, there's nothing wrong with that. Okay, it's just a question of that you have to stop.
but very Ohio National was mutual, and they
Yeah.
were a pretty good company back in the day. So my question to you is, how do you know, even with all the companies that I mentioned, they're all rated high. Every one of the leadership team says, no, we're not going to go a different direction. In fact, Ohio National they didn't blow up like Phoenix Life, but they essentially ran out of strategic
They
oxygen.
ran out
And
of money.
so then then they brought in private equity. So I think it was a little bit different, but the end result is people that had Ohio National policies or people that had Phoenix Home Life policies are, the guarantees are still baked in. But like there's in
Yeah,
Ohio
but,
National's case, but
yeah.
there's not an abundance of dividend, you know what I'm saying? And
Yeah,
so
yeah, so Ohio National is
obviously
much.
people that have policies, they could transfer them away. Like, there's options, but if you're not insurable, you have less options. How do you make sure, if you're trying to determine what insurance companies you should work with, are you looking at their Comdex score? What are things that you are
Yeah,
looking at?
so I'm way beyond that. Luckily, I've been blessed, a guy named Tom Gober. You ever hit him on your podcast?
I'm not, no.
Okay. Well, he's a real blessing in my life, and a blessing to the American people. He actually, we analyze, and this I've used a lot of his research. He actually he goes and he looks at companies' sworn statements. Okay, and he's going to be launching this service. Okay, which is going to be awesome for guys like you. It's not going to be cheap, but he actually analyzes the data, the actual balance sheets. Okay, and thank you, God, for guys like Tom. What a blessing he is in my life and to other people, because I knew private equity was really corrupt.
Right.
Okay, and it is. Okay, but it wasn't until I get to know Tom and his research balance sheet. So he looks at in sworn statements, which company officers have to say, we have so much reserves, we have these amount of mortgages and things like that, how much we have and these assets. And so he analyzes the balance sheets. So I knew really from like a moral perspective and all this crap about dividend recaps and buying companies with debt was kind of wrong. Okay, it's not wrong, but I mean, they overdo it. But then when I started to look at the collapses of insurance companies, and going back to First Executive Life, how did it happen? And the thing is it always was done by manipulating the reserves, and
I see.
moving reserves offshore, primarily to Bermuda or the Cayman Islands. They're really getting beyond the reach of the U.S. regulators. So that's going to be one of the tools which will be available to guys like you.
Okay. Well, maybe I'll have him on and we'll be able to like analyze different companies, because I mean, I find that fascinating.
No, you need to have him on.
Okay, cool. Well, well,
Matter of fact, he's yeah. So you need to have him on.
Okay.
So you have to look at a lot of these factors, but yeah, um, and the amount of surplus, and so
Yeah.
the surplus is much
Is there an
important.
insurance company? I know you want to be careful. You don't want to get hit with any defamation, so this would just be your opinion. Is there any insurance companies out there that people are doing business with that people should be careful about, or you would stay away from?
Yeah, it's that yeah. There's yeah. I mean, this is what is happening, Caleb, in this country, and it's kind of uh, it's it's how can I put it? It's a everything's going to asset light. Everyone wants to get assets under management and collect fees, and they don't want to have reserves, which an insurance company has to have to run properly. And so, what private equity is doing, or other publicly traded companies are doing, they're stripping out all the equity out of them to take them out in dividends and compensation, stock
Right.
buybacks. So there's a lot of them, which I wouldn't. And
Are any let me ask you this, because I know for the viewers or listeners, any stock company out there, obviously I think you and I would probably go on record and say don't do whole life insurance with stock carriers. Like
no,
there's
no,
a
no, no, you don't do it. I mean,
don't do that. Now, is there any mutual companies that you know of that you'd be willing to go on record to say, I would avoid this mutual company based on what I'm seeing from a balance sheet or my research?
yeah. So, yeah, I know it piss a lot of people off, but some of the stock companies like White House or Equitable or the Group 1000 companies, and I know they're probably going to come after me on that. They're and the problem is that they're very big into a lot of these HMOs, IMOs rather, but they're very very big. There's a lot of them I'd be wary of because
Okay.
we don't know what they're in.
But no major mutuals right now that you're worried about?
Not to my knowledge, it's just you don't
Okay.
know, because but from what I can see, the major mutuals, and you mentioned some of them, then some of the bigger ones, like what was it, the Thriving and
Yeah,
what's
fraternal companies,
the
Thrivent,
fraternal companies.
Foresters.
Yeah. So I would just I would just, a matter of fact, there's actually, because I still do annuity business for people, I use a brokerage firm out of I'm not going to rep name, out of in the South, and they do. I'll say like who's looking for annuity, whatever, retirement income planning, and I'll probably if I'll get 40 quotes. I probably will eliminate, if they're not mutual fraternals, I just eliminate them. So I probably would say out of maybe the 30 or 40 quotes, just using that filter, I'll probably eliminate 90% of them.
Yeah, and that's a good point. And again, this is all your opinion, so don't no one needs to sue you over your opinions, even though you get your fair share of letters. But if someone's looking at doing, an annuity or a financial product that
Yep.
long term matters,
Oh yeah.
there might be a company A that says, "Hey, we'll pay you more," but their ratings are not nearly as good. Which ratings aren't everything, but they're canary in the coal mine,
Yeah.
so they reflect. And let's say one's a stock company and one's maybe a little less attractive. They got way better ratings and they're a mutual company. Now, on paper, if you look at what do you want more? More money. This annuity will pay you more money than this over here. But what you're saying is don't just look at the
It's
payouts,
stupid. It's it's
but look at the
lunacy.
credibility of them being able to say yes to the promise they made 40 years from now.
Yeah, and the thing is, when you look at because these guys, I remember one time, this is a true story, and I knew a guy who worked for AIG, and I'm not gonna. He was a good guy, and he went to work for a mutual company who we know, and he told me he knew about it. This guy was a smart guy, okay? And he said, I said, Larry, I said, how can you promise this stuff? He says, well, everyone at the company here says, yeah, there was like, I'll be gone. By the time it blows up, I'll be gone. So that's kind of the attitude, and I think purpose of the life. This kind of I'm just saying that part of this life, we're supposed to be of service to others. And I think we're supposed to be honest
Yeah.
with weights and measures. Okay, there is no weights and measures on Wall Street. There
Yeah.
is no measure of their amount of greed. It's incomprehensible what they're doing.
Yeah, I hear you. I hear you. Barry, it's been somewhat dark so far, just in the subjects that we've talking about. As we end this
You
show,
asked.
well, yeah, I know. I signed up for this. What else are you working on that you think will add value? Because what I love about your past research, you talked about bank-owned life insurance, you've talked about corporate-owned life insurance, you're looking at but you do like heavy research, which I
Yeah.
think is important. But I also criticize that this is not just for people like you. It's like people can do a lot of research and just gain head knowledge. We see this in religion all the time. People are like
Mm.
learning all this stuff and they're getting all this knowledge, but then you realize like, is this transferring to making people's lives better? Like, how are you taking the information you're learning and making someone's life better? Here's my challenge to you, and I want to give you the floor to be able to share this. Out of all the research that you're doing, obviously you're exposing things that need to be exposed, and just for that alone, there's value. But is there other things in your research that you're saying, hey guys, I did the research so you didn't have to. I got the legal letters so you didn't have to. I'm reading these boring old old books and research so you don't have to. So how do we take the 1,000 hours plus that you've worked on and how do we make our life better? In other words, is what should we be doing? What should we be investing in? What should we be doing with our money? And we don't necessarily have to go through the same head banging our head against the wall that you did in order to that. So does my question make sense? Like I'm curious, knowing what you know, what should we be focused on? What should we be looking out for? Please help us just with all the info that you've gathered.
Okay, real or kind of a 30,000-foot view you have to take on this one, Caleb. And the more I know, the more I don't know. Believe me. But a really important thing is to, and this is get this in this next book. I lay it all out for the next generation because I'm counting on guys like you to really get some of this message out. But I love this country, okay, and it's given me a lot, but I've had to work my ass off like everyone else does. But we're the number one economy in the world. We're the number one capital markets country in the world. But in the top 30, what do you think we are in terms of retirement planning and savings?
I think you showed me this a while back. I don't remember, but I don't think it's in the top 10.
It's horrific. We're number 30. And the top
So
30,
so that's insane. So that's so in other words, we're out of the list of 30, we're 30th when it comes to our infrastructure when it comes to retirement.
yeah, I mean, Mexico is like number 18. I mean,
And what is this studying again? Like, is this showing people's
yeah, there's a
success
company
rates or
called, what?
what's the study?
Well, yeah, there's a study done by Mercer out of Australia. It's an actuarial firm. They study retirement plans, sustainability, if you will. But
Okay.
so it's independent study. This is the 17th year of doing it, 18th year. So I'm not pulling this out of my ass. I started looking at it about 4 or 5 years ago when we were like number 18, 19. Now we're number 30, and we get worse each year. And actually, in terms of integrity, so I'm just trying to help bring some honesty and some integrity into the system. And my point is that why am I? Well, so America is a great country. So if you want to have some retirement, even for you and your family, whatever, someday you're going to have something which is guaranteed, right? So you want to have purpose of retirement plan is reduce retirement income. I don't care what you say. I don't care about efficient markets, EMT, all that crap. The purpose of retirement plan is to produce retirement income. If you look at the best systems in the world, and I have, okay, which consistently the Netherlands, Israel, Iceland, Norway, and then Scandinavian countries, whatever. They're all annuity based. They're all guaranteed based. They're all insurance based. So the real good ones, okay, and I have the data, and this will be coming out this year, by the way. And I've been working on this in a long time. So because all the best retirement systems in the world are which are guaranteed based. And matter of fact, and the best retirement system in America today are if you're very rich, well, you don't have to worry anything. Or if you're a union, you work for your school teacher, a firefighter, whatever, you have a defined benefit plan. And so you can do all kinds of things. All right. So, which is a true retirement plan. So all the other stuff is bullshit, so if you look at the best retirement systems, they're all guaranteed based. And so America is we're really horrible in that. But one of the sadder things in my research is I study the World Happiness Report because how happy a country is a big factor, which again is had me in the top 30. We're like number 25. So money is. I'm not doing this just for the money, okay. But there is a correlation between some of the countries that have better
Yeah.
retirement systems and some happiness.
And
You
you're
know what I'm
saying
saying?
America is dead last because we're not doing really anything when it comes to annuities and guaranteed pensions, and all these
Yeah.
other countries that are way more sustainable, um, they're utilizing these insurance products within
Oh,
their
yeah.
state.
It's, and I couldn't believe it, but it's there. It took me a long time to put this data together, I'm just passionate. Believe me, and I always have hope, and I always, believe me, I'm blessed. I'm a grandfather now, so that's the greatest blessing in the world. I have two beautiful new granddaughters. That's awesome. So I always have hope. So a lot of the stuff which Americans used to have has been destroyed,
Yeah.
and a lot, and my hope is to educate guys like you, so you can educate other people.
So, knowing what you know, obviously no one's going to come save us. The United States isn't going to give you like even, let's see if even Social Security. If you're young, don't be banking on Social Security. But if you're already taking it, I think majority of people would be like political suicide. It's mess with that. But what you're saying is we should look to solid annuity in companies, not companies that will get taken over by PE firms. So we want to err on the side of like solid companies, but don't demonize annuities, like annuitize some of our money. Is that what you're saying? Like after your research,
Exactly.
like we should look to annuities for retirement streams.
Yeah, I mean, you can get a Mercedes or you can get a Yugo. I think, a good annuity will, it's like a Mercedes.
Yeah, Barry, how does cash value life insurance play a role in a solid retirement plan, in your opinion?
You know, Caleb, it's God bless Nelson Nash, man. What a wonderful mentor he was. When you look at it, where you can put cash savings, people are going to talk about inflation and all that stuff, and I know that. I don't want to get into that, but when you look at people need to save. And this, by the way, and in conjunction with this whole we're bad in retirement savings and how we're really not happy. Also, one of the worst countries in the world in savings,
Yeah.
and this is coming out in the book. Okay, so again, I got this from the Organization of Economic Cooperation and Development. And again, Caleb, I think we're number like 26 in the world. It's horrible. And I think it's actually probably negative now. So
Is that
countries like
because there's not really many government forced savings and investing plans? Like, are you, are you like, you, why do you think that is? Is they're giving it up to people and people aren't proactively saving and investing?
Well, it's the debt-based society. I mean, and this is
Yeah.
is instead of learning to say, there's a huge difference between saving and investing. Instead of investing and then saving, then investing, we just put everything in the market.
Yeah.
And putting your money in the market is not saving. That's and then the and again, this is kind of a religious or a moral tone, is that it's all based on debt. And
Yeah.
so the thing is, if you're close to the funnel, if you're in Wall Street, if you're in big corporate America, whatever, you're going to feed off of this whole debt model. Okay. But if you're regular American, you really have to fortify your own balance sheet. And that's why it's so important about using like cash value life insurance as a way to fortify your own balance sheet. So, I mean, I don't have all the answers, but man, when you look at all the financial crap out there, okay, and so much of it is crap. And if you look from having a high cash value life insurance company and you have a couple hundred grand in cash value, you can do a lot of really good things, and this is also one of the reasons why the private equity firms went after the life companies, because they said, hey man, look, it's sure a lot of money in there. How do we get our hands on it?
Yeah.
How do we get our fingers on it? And so I think if you can get that more to individuals, I think it's going to be awesome.
Are you a fan of people having low cost index funds, life insurance, and then using annuities in retirement? Like, do you think what other financial vehicles should people look at? Or the three things that I just mentioned,
Yeah,
would you use
yeah,
a life insurance over bonds if it was with the right company?
yeah, because the whole thing is because you're getting so many more economic benefits. And there's nothing wrong with bonds, whatever. But if you look at if there's only one financial product you buy, and I learned this from Bob Castellone, we were talking about earlier. What would it be? Would it be a stock, a bond, real estate, um, cryptocurrency, which have lost, 50% of their net asset value in the past 2 or 3 months. So, so when you look at it, cash value life, what would it be? So it's like, and God bless Bob, and I guess you're going to connect with him. But yeah, when you look at it, it's a systematic savings plan. It's a very large death benefit in case some people die prematurely. and I've had a lot of claims, and I know the importance of it, including my own family. So I'm not
Yeah.
speaking out of it's professionally managed. I mean, you have to, life companies have to manage money just like everyone else. It's a systematic. People need systems. I'm a systems guy. I'm a very anal guy. I like systems. I like great systems. You can get access to the money, and there's so much you can do with it. And as I told people, you just need a Mickey Mouse plan. And I think I went through the Mickey Mouse plan before, right?
Go over it again.
Do you know? Okay, so, well, this is a true story. Walt Disney, 1952 thereabouts. When he went through bankruptcies a couple times and whatever. It was a fascinating story, but when 1952 thereabouts, he had this idea of having a clean theme park, and I'm probably like 35 miles away from it right now. But anyway, Orlando, but no, actually probably 50 miles. But anyway, so he had this vision of a clean theme park, and at the time, everyone said, "Bob, Walt, you can't have a clean theme park." And he went to Wall Street, and because he had dealt with Wall Street and his investors and the whole thing, everyone said, "You can't do it, Walt." So everyone turned him down. His brother turned him down. Wall Street turned him down. And this is a true story. And so around 1952, he had a vacation home, like a winter home in Palm Springs, and he sold that, and he got some money from some of his employees. But the major money he got to fund the Disneyland was funded with a life insurance policy, around 200 grand at the time, something like that, which is a lot of money back then, like a couple million bucks. So actually, Walt Disney used the cash value of his life insurance to fund Disneyland. And this is true. So all you need is a Mickey Mouse plan.
Yeah,
And
I
that's
love it.
true.
When one of your books, Pirates of Manhattan, you talk about bank-owned life insurance. And how did you stumble on that? I think you said in your research that over 3,000 banks in the United States have
Yeah,
their
they still
tier
do.
1 capital and bank-owned life insurance. Just for our listeners, why don't you just unpack how you discovered that? And it's not very easy to find out where these banks are
No,
holding
and
their
they're not making it
money,
and they're making it hard.
but it's possible, and you went through that, and I'm just curious, it's like, why do banks care about life insurance, and why do they own bank-owned life insurance?
Economic reasons. They're no dummies. The reason why banks buy it, and they still do, and I will be having some of those numbers on that. I stumbled upon it. There's grace of God. I worked really hard on it, but it's just no one was. At the time I asked everyone. I knew banks. I read a couple articles in the Wall Street Journal about banks buying it, and I called these brokerages and the companies. I called New York Life and Northwestern. No one would talk to me, and then no one would talk to me. And then I befriended a lady at the FDIC. This is a tough time in my life. This is like 20 years ago, and no one would talk to me about it. But I started researching it, and then I found the Federal Reserve. This one I could start doing more research on the Federal Reserve, and I found out. I was like, holy moly, how the Federal Reserve uh, qualified life insurance, bank-owned life insurance, as a one of the safest assets that could be in a bank. Or part of the tier one capital. See, when the bank structure, the most important thing on any bank is their tier one capital, because that determines how much money they can lend out to the public. But anyway, no one would talk to me. But so I started digging, and this is the time when I used to I had to put my MasterCard in for like $5 every article for like a Wall Street Journal article. And I started just calling and digging and digging. And then I found one book that talked about it. Then I befriended this lady. I sent her candies. I didn't have any money at the time. I was going through a hard time. And she showed me how to download the bank-owned life insurance. And I was just like stupefied. Talk about it. And matter of fact, I published this book in 2006, 2007. So this is 19 years ago. And this is still true to this day. Now, the FDIC, it's very difficult to go in there to figure this out. Okay. Because I have to update some of the numbers. But in 19 years, went in mainstream media, and I've talked to everyone from the Journal to the New York Times, to Bloomberg, you name it, not one of them will admit to this fact. Banks still own a huge portion of their tier one capital life insurance, and they do it because it's very safe. The asset itself is on their balance sheets, so the bank can lever it. So if they have $1 billion, or like, I think JP Morgan has like 20 billion, so they can lever that to lend out more money to the business. They know everyone's going to die. When people die, the money comes into the bank, income tax free. The cash value increases when it goes up, a couple
Yeah.
$100 million a year, and it actually improves their income statement.
Well, yeah. It's in a way, it's shocker. They're able to have a lot of liquidity, what they can lend against. They also can insure their key employees, and there's a lot of benefits that they get with insurance. And it's like if banks are doing it, that's one of the reasons I don't think it's super well known. Because if banks are doing this, then it's like, why do you think whole life insurance is a scam? It's like, why would you? It's like,
It's not.
okay,
It's not. That's the
I
whole.
would why would banks, and so is that why you think they keep it hush hush? Like, why do people care? Like, why do you think it's such a like a hush hush thing that banks put money into life insurance?
You got me, Caleb. Because it's a. I've been referred to CNBC and to a top producer through a mutual guy who I knew was one of the top writers at Forbes at the time. And let me just put it this producer said. He said, "You're effing crazy." Okay, I was at Bloomberg, right down Lexington Avenue there. God, it must have been 12, 13 years ago. And I was there and I presented all this facts to Bloomberg. And the producer later on said, "We can't tell people this because it's going to piss off our advertisers." No, the thing is
But
that
why would it piss off the advertisers? Like, is there Wall Street? Like, why do
yeah,
people
well,
care about? Because is the reason just, in your opinion, the reason why people don't love mutual life insurance companies is it takes money out of Wall Street. So, for example, if you're making your money and you want people to invest in your fund or you're getting paid, if they put money into insurance, that's assets that you can't now charge fees. Is that
that is
am
correct.
I
Yeah,
on the right track or am I missing
you're
something?
100% correct. You're 100%. It's competitive. The Wall Street wants to gamble. They want deals. They're transactional. They don't care anything about long-term value. They want transactions. How much am I making?
Kind of like the drug companies might not be the biggest fan of supplement companies because they don't necessarily want you, newsflash, to not take their drugs. Like they want you to be hooked. And so when people say big pharma, you could also say big Wall Street. Well, what's the name
Yeah, it's
for?
the same thing. I mean, it's just, it's I was watching the Super Bowl yesterday and I was like, "Oh my God, some of these drugs, how's anyone the side effects of it, it must gonna kill you." So what we're to say here we're talking about a whole life, whatever. Let's say a good high cash value whole life, which is sound. It's a warehouse of wealth. It's a major death benefit. It's for your family, love and caring. It's contractual guarantee. It's contract. Okay. All
Yeah,
lawyers out there, it's a contract. It's a legal contract. So it's not sexy, but boy, it works. So it's a legal contract. So instead of putting into a legal contract, and I'm not against all this other stuff. I'm a capitalist, okay? So every good house needs a foundation. I'm saying this is a good foundation for people. The other stuff is crap. And it's just I've mentored some young men, because I'm a registered investment advisor, blah blah blah, and I've seen them get so hooked into this cryptocurrency, it just breaks my heart, and
why is
so
crypto bad in your opinion?
well, this is my opinion. I don't know. I'm not saying blockchain technology is here to stay. And I just don't see any inherent value. It doesn't have any. I'm not saying I'm just saying it has no place in retirement plans in
I see.
particular.
I see. You shouldn't be gambling it in retirement planning. Barry, you are you're an interesting person to talk to. There's always, you never know what type of research you're working on. And I do let me just recap our conversation. Private equity is making waves and it's affecting every industry. We got to be very diligent to see if we're working with entities and institutions that private equity needs to get into. We need to be really careful how that can affect us. You talked about the mutual insurance companies just by default have more. They're not insulated completely, but they have more insulation than stock companies. Also, ratings matter. If a company that you're working with has ratings that are starting to drop, just know that there's more potential issues. We covered what happened with Ohio National and Phoenix Home
Okay.
Life. We also talked about how America is like almost dead last or is dead last when it comes to our infrastructure, when it comes to retirement planning. A lot of that is because we're when it comes to society, we're not leaning on insurance products. I'm saying it, you don't have to, but I think it's like other countries are utilizing pensions and annuities, and in America, like we're not. And so people are so in a debt-based society, people are not saving and investing to the levels that they should. And then they have a chunk of money, but they're not spending it or they're not making income out of it very effectively. And so you're a fan of really understanding like good planning is if you can work with insurance companies that are solid and utilize insurance, life insurance and annuities that you potentially could get more income out. That's something that that you should look into. We also covered bank-owned life insurance and how over 3,000 banks in your research have some of their tier one assets. Some of these banks have billions of dollars in bank-owned life insurance, and if it's good enough for them, it's just something that you should be looking into for your own life. Is there anything else that we did not cover that I should summarize or we should mention before we land the plane?
Yeah, I mean, you just keep doing what you're doing, Caleb. I think this is really important, and this is serious stuff because President and he introduced executive order introducing alternative assets, which is private equity. They want to stuff this stuff in 401ks, and to me, I'm sorry.
The flip side, just to give the counter argument, is you're giving people the ability to participate in some assets that they don't have access to. But you're saying more people are going to lose money, just like in crypto, in your opinion, than people are going to gain by having access to the new opportunity. Is that your take on the whole matter?
Yeah, most definitely, because it's like
And
giving
you're
us.
kind of funding if they're able to get their hands on more money, then you're potentially funding more problems.
Yeah, there's no question about it.
Because you're funding this behavior. So if you believe private equity is leaving more people worse off, and then you're voting also for 401ks to now where you're literally just giving them more oxygen and fuel.
Yeah, because well, the reason why they're going after the retail space because they can't get exits, Caleb. So they're looking for fresh meat. They can't. I was at as a Bain Capital, Bain Research, whatever. I was like 30,000. I can give you the exact figures, roughly around 30,000. I can't sell these companies. They can't sell
Mm.
them to another entity. Now, this whole model worked beautifully when they were, when you get into interest rates, when interest rates were nothing, they could buy
Well,
this
and they're
house
coming back
really,
down.
and unfortunately that causes more speculation. And
Yeah.
so if interest rates come back down, it's going to destroy the value of the dollar even more.
Yeah.
So the thing is that, and also people have to understand, see, private equity would not exist, Caleb, without the public pension funds. This is what people don't
Mm.
understand. If I work for this, say you're in the state of Tennessee or I'm in Florida right now, or California, whatever, and I'm in a public pension plan, okay, and they're or an endowment. I mean, now the individual retirees, the pensioners, they don't have any of this. They don't have any of this investment risk. There is
Yeah.
none. It's the state who's on the hook, and if the pension plans go through a shortfall, it's the taxpayers on the hook. It's not the
Yeah.
private equity firm.
I'm with you.
Okay, your 401k, you're asking people. It's like you with the 401k, Caleb. It's like you got all the parts to a car. You're dumping them in the driveway, saying, "Now put the car together."
Yeah.
And that's what they're
Well,
trying to do with the 401k.
you and yeah, if something's not adding value, I mean, this is a whole separate conversation, but it's something that is interesting philosophically. What value does the stock market actually give? Well, it gives people the ability to be liquid. It potentially creates people that can take on more risk, more innovation. So there's value there. But like when people are trading on and off, and like you could ask, like people are getting rich by maybe not creating massive value. So then private equity is an extension of that. And then you're just now giving it more oxygen, more attention. I think ethically, and this is another thing, is like if people are putting their money in index funds in the S&P 500, you're probably funding companies that hate your values. There's a good
Yeah,
chance that you're funding
there's
companies
a
that might.
major problem with, and I addressed that, by the way. There's a major
Right. And
problem
so
with
I
index
think
funds.
I think I heard a talk the other day that went into that, and it was convicting to me because I'm like, man, for those of you who know me, I have what I believe is strong values. But if you look at where I'm investing my money, I'm literally investing. It's very hypocritical, but it's easy to get caught up in that. And I think that could be maybe a part two where we talk about
Yeah,
about that. But Barry, thank you so much for your time. It's always a joy. And I
great
hope
to see
you
you.
continue to soak up that sunshine in Florida.
Yeah, it's beautiful down here. But yeah, so to keep going, Caleb, we need you guys like you because there's a lot more to be people to benefit. And there is we didn't even get into that. There's a major problem with indexing, and actually there's a guy by the name of Mike Green who's really, you may want to have on at some point.
Okay, and we'll just include your resources and books down in the description. So if you want to support Barry and all, and I'm also trying to get him to our event. So if you've not gotten tickets to our event, you will also have links down below to our life insurance summit. Stay tuned. There's a chance that you actually might be able to meet Barry in person if I can twist his arm and get him there. So anyways, Barry, thank you so much for coming on. And as always, look forward to the next time we get to chat.
Awesome. Thank you.
If you're an advisor, life insurance agent, or someone who just loves the life insurance space, we have a must-attend event for you. It's our 5th annual Life Insurance Summit, June 15th through the 17th, right here in Nashville, Tennessee. Not only are we going to have the biggest names in the life insurance space, but this is also an incredible opportunity for you to meet and connect with like-minded individuals and be a part of our ever-growing community. Learn more and get your tickets before they sell out in the link in the description or pinned comment. Can't wait to see you there.